So if you have been following my classes, you know what is happening now. Now we discuss what are balance sheets, and now we are looking at an actual balance sheet of a real world company we all know, that is Alphabet or Google. Now you can see here that like I said, every balance sheet has two sides. One is assets and the other one is equity plus liabilities. And this is the same case here also. Here we have total assets of $359 billion. This is the assets of Google as on 31st December 2021. And what are the total equities and liabilities of Google? That's always matches. Why? Because it's a balance sheet. Assets is equal to equity plus liabilities. What are the total liabilities of Google? $107 billion almost. And the total equity of Google, that is around $251 billion. Total liabilities plus equity of Google is equal to assets, that is $359 billion. So let's first see the liability side. And in the liability side, let's see the short-term debt and the long-term debt. In the current liability side, that is a short-term debt, we have certain accounts payable, that is your creditors, accrued compensation, basically your salaries which you need to pay, accrued expenses, those expenses which you have deducted but not yet paid, and other current liabilities. Accrued revenue share, that means those share, that is those advance payments received from your customers. And deferred revenue, so accrued revenue and deferred revenue are almost the same thing. And income tax payable, basically those liabilities you have to pay the piper, right? So the government needs to be paid. So these are basically the payable taxes Google needs to pay within this year. How do I know that it will be paid within a year? Because it is the part of current liabilities, right? Current liabilities are to be paid within a year. So the total current liabilities which Google will pay this year amounts to almost $64 billion. Now, the comes part, the long-term debt, that is debt which will be paid after a year. This is not to be paid within 365 days. Deferred revenue, again advance from customers which are being given for more than a year. Income tax payable, non-current, these are payable after a year. Deferred income taxes, this is more of a general entry and it's not required to analyze your business too much. This is much more of a general and a taxation entry. It doesn't have too much impact on your business affairs. Operating lease liabilities, other long-term liabilities. That is those liabilities which are to be paid after a year. These are all bundled here. And this gives you the total liabilities of Google of $107 billion. So Google has $359 billion of assets. And out of those $359 billion, only 107 have been funded by taking liabilities. The rest is all put up by Google in form of equity. Now, as a business owner, or when you are trying to analyze the financial statements of any company, be it your own or even your competitor, one of the most important things you have to look when you are looking at balance sheet is these figures, which is total current assets and total current liabilities. The fact is, total current assets of Google is $188 billion and total current liabilities is $64 billion. What this basically means is that Google has liquid assets. Liquid means what? Basically those assets which can be converted into cash fairly easily. So these assets can be converted into cash in $188 billion within a year. And Google will have a cash flow of $188 billion and it requires to pay only $64 billion out of these cash flow. Now, if you look more closely, you will find that Google has $139 billion of cash in its balance sheet. That means, in reality, Google doesn't have any kind of working capital which is being invested in the business. Because even if all these liabilities came on a single day and says, okay, for example, let's say all the accounts payable of Google came and say, I need my cash. I need you to pay me right now. Google can very easily make that payment because Google has so much of cash on its balance sheet, almost $140 billion. So it is very important after looking at the balance sheet in forms of current assets and long-term assets and equity and debt, you look at the balance sheet in terms of working capital, which is current assets minus current liabilities, excluding cash. Why cash is excluded? Because cash, we already have it in liquid form, right? So current assets and current liabilities are two other things which you have to look very closely when you're looking at the company's balance sheet. So this is how a balance sheet looks like in real world. In our example, we had prepared the balance sheet in T form. T form means that the liability side was here and the asset sides are here. In real world, the balance sheets are prepared in a horizontal form. That means that the asset sides are up and the liability side are down. But no matter how it is prepared, be it T form, circular, rectangle, whatever, balance sheet will always balance. That means that total liabilities and equity will be always equal to total assets of the company.